In October 1929, it was a stock market crash. In 1991, it was a real estate bubble bursting on the other side of the world, in Japan. In 2008, it was subprime mortgages and the collapse of a 150-year-old investment bank. 3 different decades, 3 different countries, 3 completely different-looking triggers. Ask most people what caused each of those recessions, and you'll get 3 different answers, each one tied to whatever made the news that particular year. They're all missing the same thing. The trigger is never the cause. It's the pin, and underneath every one of those 3 pins was the same balloon inflated for years by the same mechanism. A boom in private credit that let households and companies borrow more during the good years than the economy could actually support. The severity of a recession isn't set by the size of the shock that triggers it. It's set by the size of the debt that built up before it. The bigger private credit grows during an expansion, the deeper the hole waiting on the other side of it. Well, this video is the autopsy of that mechanism, not of one company, not of one country, but of the hidden force sitting underneath nearly every serious recession in modern economic history. And unlike a lot of theories about what drives the business cycle, this one isn't a hunch or an ideological position. It's been tested directly against more than a century of economic data across more than a dozen countries, and it has held up. What that test found is coming later in this video. First, the mechanism itself, because once you see how it works, you'll recognize it in every case study that follows. 3 case studies, 1 statistical test spanning nearly a century and a half of global data, and a question at the end of this video about whether the same mechanism is quietly running again, right now, underneath the economy you're living in today. To see the mechanism clearly, it helps to borrow a framework built specifically to explain it. The work of the American economist Hyman Minsky, who spent most of his career, from the 1960s through his death in 1996, arguing that financial crises aren't random accidents imposed on the economy from outside. They're something the economy manufactures internally on a schedule out of its own success. For most of his career, mainstream economics largely ignored him. The post-war decades had convinced a lot of very smart people that the business cycle had essentially been tamed, that recessions were a solved problem managed away by modern monetary policy. Minsky's ideas were dusted off and taken seriously, largely, after 2008, when the crisis played out almost exactly the way his framework predicted it would, decades after he first wrote it down. Minsky described 3 stages that credit tends to move through over the course of an economic cycle. Right after a crisis, lenders and borrowers are cautious, what he called hedge finance. Debt gets taken on conservatively, and borrowers can comfortably cover both the interest and the principal out of their regular income. As the good years continue and memories of the last crisis fade, the system drifts into speculative finance. Credit standards loosen, borrowing increases, and borrowers can still cover the interest, but only by continuously rolling over the principal, betting that asset prices will keep climbing long enough to make that bet work. Eventually, in the final stage, the system reaches what Minsky called Ponzi finance. Borrowers can't even cover the interest out of their income anymore. The entire arrangement depends on being able to sell the underlying asset for more than they paid for it. It's a structure that only works as long as prices keep rising, which is, by definition, not forever. Minsky's most quoted line distills the whole idea into 3 words. Stability is destabilizing. The longer an economy goes without a crisis, the safer everything starts to feel, and that feeling of safety is exactly what pushes lenders and borrowers further out along the hedge, to speculative to Ponzi spectrum. Nobody wakes up one morning and decides to cause a recession. A recession is the accumulated result of millions of individually reasonable decisions to take on cheap debt during years that felt, at the time, like the safest possible moment to do it. The bank loan officer approving a mortgage in a rising market, the investor buying stock on margin during a bull run, the household refinancing to pull equity out of an appreciating home. None of them are doing anything reckless by the standards of the moment. They're all responding rationally to a period of calm. The calm itself is what makes the eventual reversal so violent, because it's what allowed the debt to build in the first place. This is worth sitting with because it changes who this video is actually about. It would be more comfortable in a way if these three collapses had been caused by a handful of reckless actors making obviously bad decisions everyone else could see coming. That's not what the data shows. Each of the three case studies in this video was built piece by piece out of ordinary people and ordinary institutions making individually defensible choices at scale during a period that genuinely felt safe at the time. That's a harder story to tell than a villain narrative, and it's also the true one. And it's the reason this video treats the mechanism, not any single individual, as the thing worth understanding. That's the mechanism this video is going to trace through three specific moments in economic history: the US stock market in the 1920s, the Japanese banking system in the 1980s, and American household debt in the years before 2008. Each one a different asset, a different country, a different decade, and the same underlying pattern of credit, quietly outrunning the economy's ability to support it. Watch, in each case, for the same shape: a period of calm, a period of rising confidence, an expanding pool of debt that nobody involved thought of as dangerous at the time, and a trigger near the end that gets remembered as the cause when it was really just the last domino in a chain that had been building for years. One more piece of the framework is worth establishing before the case studies begin, because it explains why this mechanism is so easy to miss while it's happening, and so obvious in hindsight. Debt, unlike a lot of economic warning signs, doesn't announce itself. A stock market crash makes headlines the day it happens. A bank failure makes headlines the day it happens. A decade of gradually rising household debt-to-income ratios, or a steady climb in a country's credit-to-GDP measure, produces no single dramatic day, no clear moment for a journalist to point to, no obvious villain. It just accumulates quietly in the background, while the economy, its inflating, looks from the outside like an unambiguous success story. That's precisely why the trigger gets remembered as the cause. The trigger is visible, the debt was not. Not until the trigger revealed it, at which point the story that gets told is almost always about the visible part rather than the years of invisible accumulation underneath it. The US stock market's rise through the 1920s looks, from a distance, like simple optimism. The Dow Jones Industrial Average climbed from around 63 in August 1921 to 381 by September 1929, roughly a six-fold increase in 8 years. What made that climb dangerous wasn't the size of the gain, it was how much of it was being financed with borrowed money. Buying stock on margin meant an investor could put down as little as 10% of a stock's price in cash and borrow the rest, typically through a broker, who had in turn often borrowed that money from a bank, which had often borrowed it, in turn, from depositors expecting perfectly ordinary, safe returns. These brokers' loans, the debt fueling the entire margin system, grew from roughly $3 billion in March 1926 to a peak of $8.5 billion by October 1929. That's not a market rising on genuine long-term investment. That's a market rising on leverage, where a large share of the buying pressure pushing prices higher was coming from money that would need to be paid back regardless of what happened to the stock afterward. It's worth being clear about why 10% margin makes a market this fragile. If a stock bought with 10% down falls by just 10%, the entire cash investment is wiped out, and the broker is entitled to demand more collateral immediately. That means a comparatively modest price decline, of the kind that happens routinely in any market, can suddenly force a wave of investors to either come up with fresh cash or sell. And in a market where a meaningful share of participants are leveraged the same way at the same time, that forced selling doesn't stay contained to a few unlucky traders. It becomes systemic almost immediately. This wasn't limited to a small circle of professional speculators either. Margin trading in the late 1920s had become widely accessible to ordinary middle-class Americans for the first time, marketed as an easy way to participate in a stock market that seemed to only go up. Brokerage firms opened branch offices specifically to serve this new class of small investors, and newspapers regularly ran stories celebrating ordinary clerks and shopkeepers who had made small fortunes buying stock on credit. That popularization is itself part of the Minsky pattern from Block 2, a period of calm and rising confidence pulling in progressively less sophisticated, more highly leveraged participants, right up until the moment the mechanism reversed. The people most exposed when the crash came weren't Wall Street professionals who understood the leverage they were carrying. They were exactly the ordinary households the boom had spent years pulling in. That structure is what turned an ordinary market correction into a collapse. When prices started falling in October 1929, investors who had bought on margin didn't just lose value on paper. They received margin calls, demands to put up more cash immediately, or have their stock sold to cover the loan. Forced selling from margin calls pushed prices down further, which triggered more margin calls in a self-reinforcing spiral. On what became known as Black Monday and Black Tuesday, October 28th and 29th, 1929, the market fell roughly 13% and 12% on consecutive days. By July 1932, the Dow had fallen all the way to 41.22, a decline of roughly 89% from its 1929 peak, a level of destruction the index would not fully recover from, in nominal terms, for roughly another quarter century. The headline explanation for the Great Depression has always been the stock market crashed. The mechanism underneath that headline is that years of margin debt had built a market whose price level depended on an ever-growing supply of borrowed money, and any interruption to that supply was always going to bring the whole structure down with it. The crash was the pin. The margin debt was the balloon. It's worth noting what didn't cause this particular crisis, because the contrast sharpens the point. The 1920s didn't see a pandemic, a war, or a sudden foreign shock disrupt the American economy in 1929. The trigger came from inside the financial system itself, a market correction that, in a less leveraged environment, might have been a routine pullback absorbed within a few months. It became the Great Depression specifically because so much of the market's prior gains had been financed with debt that a routine correction was never going to stay routine. That gives us the first data point in a pattern this video is about to repeat twice more on two different continents with two completely different asset classes. Move forward 60 years and cross the Pacific, and the same mechanism appears again, this time built on bank lending into real estate instead of brokerage lending into stocks. A completely different asset, a completely different regulatory system, a completely different culture around debt, and yet the identical underlying pattern. After the 1985 Plaza Accord pushed the yen sharply higher, Japan's export-driven economy came under pressure, and the Bank of Japan responded by cutting interest rates aggressively. Japanese banks, flush with cheap funding, expanded lending to the private sector explosively through the second half of the 1980s, with land increasingly used as collateral for loans that then financed the purchase of more land. In a feedback loop between rising prices and rising credit, commercial land prices across Japan's 6 largest cities rose by roughly 300% between 1985 and 1990. The Nikkei 225 stock index, which had been trading around 13,000 in late 1985, climbed to a peak of 38,915.87 points on December 29, 1989, roughly triple its level barely 4 years earlier. At the height of the bubble, the numbers reached a scale that's hard to process in retrospect. The Tokyo Stock Exchange's total market capitalization briefly exceeded that of the entire U.S. stock market. The Nikkei 225 traded at a price-to-earnings ratio that peaked somewhere around 60, several multiples above what would be considered a normal valuation in most developed markets, and a widely repeated, if partly apocryphal estimate held that the land under Tokyo's imperial palace was worth more than all the real estate in the state of California combined. None of that valuation was resting on Japanese corporate earnings growing to match it. It was resting on a banking system that kept extending credit against collateral, whose value depended entirely on credit continuing to be extended. A cultural narrative grew up around the numbers, the same way it always does during a Minsky-style speculative phase. The idea that Japan's economic model was simply different and therefore exempt from the valuation rules that applied everywhere else. Books published in the West during these years argued in earnest that Japan's economic system was fundamentally superior to conventional capitalism, and inside Japan, that conviction hardened into something close to consensus. The logic was circular in a way that's obvious only in hindsight. Prices kept rising because Japan was supposedly different, and Japan was assumed to be different because prices kept rising. That's not a uniquely Japanese failure of judgment. It's what confidence sounds like in the late speculative stage of every credit cycle in this video, right before the reversal. The same overconfidence that would show up again in a different country and a different asset class less than 2 decades later. The Bank of Japan began raising interest rates in late 1989 to cool the speculation, and the unwind that followed was brutal and slow motion at the same time. The Nikkei fell roughly 60% within about 3 years of its peak, eventually bottoming at 7,862 in March 2003, a decline of nearly 80% from the December 1989 high, and a level the index would not reclaim until 2024, 34 years later. Commercial land prices fell for 14 consecutive years, starting in 1991, with 6 city commercial land values ultimately declining by well over 80% from peak to trough. Japanese banks were left holding roughly 100 trillion yen in non-performing loans by the late 1990s, loans that had been made against real estate collateral that had simply stopped being worth what the banks had assumed. A hole so large that 2 major Japanese financial institutions, the Long-Term Credit Bank of Japan and the Nippon Credit Bank, ultimately had to be nationalized by the government in 1998 just to keep the banking system functioning. The result was what economists now call Japan's lost decades. By 2017, Japan's economy was barely larger than it had been 20 years earlier, a stretch of near-zero growth, long enough that an entire generation of Japanese workers entered, and, in some cases, nearly exited their careers without ever experiencing the kind of sustained expansion their parents' generation had taken for granted. Different asset, different country, different decade, same mechanism. Years of credit expansion inflating collateral values, followed by a collapse proportional not to the trigger, but to how much debt had accumulated underneath the boom. And notice what's absent from this version of the story, compared with the popular narrative. There's no single dramatic villain, no one bank whose failure gets blamed the way Lehman Brothers would be blamed nearly 2 decades later. Japan's collapse didn't need one. The debt was distributed across the entire banking system, which is exactly why the damage took over a decade to fully clear. The most recent version of this pattern is also the one most people already think they understand, because it happened during most of this video's audience's own adult lifetime: the subprime mortgage crisis and the 2008 financial crisis. The standard story focuses on the trigger: bad mortgages, the collapse of Lehman Brothers, a credit freeze on Wall Street. The underlying mechanism, laid out in detail by the economists Atif Mian and Amir Sufi in their research and their book House of Debt, starts years earlier inside millions of individual American households, long before anyone outside the mortgage industry had heard the word subprime. Total household debt in the United States roughly doubled between 2000 and 2007, reaching about $14 trillion. The ratio of household debt to household income climbed from roughly 1.4 to 2.1 over that same period, the largest jump in that ratio since the 1920s, the same decade that produced the margin debt bubble from Block 3. That increase wasn't concentrated among a small number of speculators. It was spread across ordinary households, taking on mortgage debt, home equity lines, and consumer credit, encouraged by years of rising home prices that made borrowing against a house feel, at the time, like one of the safest financial decisions a family could make. In Minsky's terms, a huge share of the American housing market had drifted from hedge finance into speculative and, in some of the more extreme lending products of the mid-2000s, outright Ponzi finance, interest-only mortgages and so-called ninja loans, issued to borrowers with no income, no job, and no assets verified, all of it resting on the assumption that home prices would simply keep climbing forever. Mian and Sufi's research found a consistent pattern across the country. Counties and regions where household debt had grown the most going into 2007 experienced the sharpest declines in consumer spending once the crisis hit in 2008 and 2009. Not because those households had necessarily made worse individual decisions than anyone else, but because heavily indebted households have far less room to keep spending once home values fall and credit tightens. A homeowner with little or no debt who watches their home's value decline can simply keep living their life largely unchanged. A homeowner who financed most of that home's value with debt has far less room to absorb the same decline and tends to cut spending sharply the moment their perceived wealth disappears. That difference in behavior, multiplied across tens of millions of households, is what turned a housing correction into a national recession. The human cost that followed was severe. Roughly 8 million American jobs were lost, and more than 4 million homes went into foreclosure. This is, in miniature, the same mechanism from Block 2 operating at the level of an entire national economy, rather than a single financial market. A household economy running mostly on hedge finance can absorb a shock. A household economy that has drifted collectively and without anyone planning it that way into speculative and Ponzi-style leverage has almost no shock absorption left, and the same trigger that a healthier economy would shrug off instead cascades into a multi-year downturn. The financial press covered this recession correctly as a story about subprime mortgages and Wall Street risk-taking. What the household debt data adds is the part that isn't visible in a headline about Lehman Brothers. The system was already fragile before any specific bank's name showed up in the news, because the debt behind the fragility had been building quietly and legally in ordinary households for most of the preceding decade. Notice the shape of this case study against the previous two. In 1929, the debt sat with individual stock investors and their brokers. In Japan, it sat inside the banking system itself, lent against real estate. In 2008, it sat with tens of millions of ordinary households spread across every state in the country, each one a small, individually reasonable decision to take on more mortgage debt while home prices kept climbing. 3 completely different populations of borrowers in 3 completely different economies, decades apart. And in every case, the debt was the thing quietly accumulating underneath a boom that looked from the outside like nothing more than good economic times. One more layer made the 2008 version of this mechanism especially hard to see coming, even for people paying close attention: securitization. Rather than a single bank holding a risky mortgage on its own books, the way a 1980s Japanese bank held a real estate loan. Thousands of individual mortgages were bundled together, sliced into tranches, and sold to investors around the world as mortgage-backed securities, often carrying investment-grade credit ratings that implied a level of safety the underlying loans didn't actually have. That process didn't reduce the total amount of household debt in the system. It just spread the risk of that debt across a much wider, more opaque network of institutional investors, which is part of why the eventual unwind reached so far beyond the housing market itself, into banks and investment funds that had never directly issued a single mortgage. The debt was the same debt underneath all of it. It had simply been repackaged enough times that almost nobody holding the final product could see or was incentivized to ask what the household-level fragility underneath it actually looked like. A thesis this broad only earns its credibility if it can survive being tested against the cases that don't fit cleanly. And there are two worth naming directly, because pretending they don't exist would be a bigger problem for this video than admitting them. A channel built on documented investigation loses that credibility the moment it starts cherry-picking only the examples that fit a tidy narrative and ignoring the ones that complicate it. The COVID-19 recession of 2020 was not a credit cycle event. It was triggered by an external, real-world shock, a pandemic that shut down entire sectors of the global economy, almost overnight, regardless of how much or how little private debt had built up beforehand. Governments and businesses hadn't spent the preceding years piling up unsustainable household or corporate debt the way they had before 1929, before Japan's bubble, or before 2008. The trigger came from entirely outside the financial system, and the dot-com crash of 2001 was, by comparison to 1929, Japan, or 2008, a relatively shallow recession, driven far more by speculative equity valuations in a narrow sector than by a broad private debt buildup across households and the banking system as a whole. Both of these cases actually strengthen this video's thesis rather than undermine it, once you look at what they're doing in the data rather than just in the headlines. The credit cycle mechanism explains why some recessions turn into prolonged, systemic disasters, the deep, slow-healing kind, without claiming that every economic downturn has to follow that same pattern. An external shock like a pandemic can still cause a recession without a credit boom behind it. And a downturn, triggered mostly by a stock valuation bubble, with comparatively little debt attached to it, tends to be exactly what this framework would predict. Sharp, but shallow and quick to recover from. Which is precisely what happened after the dot-com crash, where the broader economy returned to its prior level of output within a relatively short window, compared with the years-long recoveries that followed 1929, Japan, or 2008. Less debt going in means less damage coming out. That's not an exception to the thesis. That's the thesis, running in reverse. If a video willing to test its own central claim against the cases that don't fit neatly is the kind of channel you want in your subscriptions, this is a good moment to hit that button. We publish one documented economic or business autopsy like this every week. Back to the mechanism. There's a broader point buried in these two exceptions that's worth surfacing before moving to the proof. A framework this useful isn't one that claims to explain literally everything. That kind of framework is usually a sign of ideology dressed up as analysis, the exact trap this video's own research notes were built to avoid. A genuinely useful economic mechanism is one that makes a specific, falsifiable prediction. More debt before the trigger equals a deeper and longer recession after it. Less debt before the trigger equals a shallower and shorter one. COVID and the dot-com bust aren't awkward outliers this video has to explain away. There are two more data points confirming the same rule, sitting on the opposite end of the spectrum from 1929, Japan, and 2008. Put the three case studies from this video's Auto 3 next to the two exceptions from this block, and a clear rule emerges. The credit cycle mechanism doesn't explain every recession. It explains the difference between a recession that stings for a couple of quarters and one that scars an economy for a decade. And that rule isn't just a narrative pattern this video is choosing to highlight because it fits neatly into three case studies. It's something that's been tested directly at scale against more than a century of global economic data across every recession economists have reliable records for. Here is the number that turns everything in this video from a pattern into a finding. Three case studies, however carefully chosen, are still just three stories. The kind of evidence a skeptical viewer is right to treat with some caution, because it's always possible to find three examples that fit almost any narrative if you go looking hard enough. What separates this video's thesis from an appealing but unproven pattern is a body of empirical research that tested the idea against far more than 3 examples, using methods designed specifically to rule out coincidence. Economists Moritz Schularik and Alan Taylor studied 14 advanced economies over the period from 1870 to 2008. 138 years of data, spanning 79 separate banking crises and well over 1,000 individual country-year observations. Their conclusion, published in the American Economic Review in 2012, was direct. The growth rate of private credit in the years before a downturn is the single best predictor of whether that downturn turns into a financial crisis. Once credit growth is already in the model, adding other standard economic variables, unemployment, inflation, stock market performance, adds remarkably little additional predictive power. Their own summary of the finding was blunt. Financial crises are, in their words, credit booms gone wrong, and policymakers who ignore credit growth do so at their own peril. It's worth pausing on what makes this finding different from an ordinary economic correlation. Researchers weren't simply noticing that some famous crises happen to follow credit booms and building a narrative around a handful of examples. They built a systematic dataset covering nearly a century and a half across 14 separate countries with different currencies, different political systems, different banking regulations, and different historical circumstances, and tested credit growth against every other major economic variable available for the same time periods. The result held up not in one country or one decade, but across the entire panel, through 2 world wars, the Great Depression, the Bretton Woods era, the stagflation of the 1970s, and the globalized financial system of the late 20th century, each with its own distinct policy environment and its own distinct set of shocks. A follow-up study by the same group, along with economist Oscar Jorda, published in the Journal of Money, Credit, and Banking in 2013, extended the analysis across 223 separate recessions in the same set of countries, 173 ordinary recessions, and 50 that came bundled with a financial crisis. The pattern held at every level of detail, across every era in the sample, from the classical gold standard period through the modern floating currency system. In the expansion years leading up to a recession that turned into a financial crisis, excess credit growth averaged roughly 1.3 percentage points a year, more than 5 times the roughly 1/4 percentage point of excess credit growth seen before an ordinary recession, and the aftermath tracked the buildup exactly the way the theory predicts. For every 1 standard deviation of excess credit growth going into a downturn, the pace of recovery over the following 5 years slowed by roughly 1 to nearly 2 full percentage points. Recessions that came with a financial crisis left the size of the economy running 3 to 4% below its prior peak, even 3 years after the downturn began. A gap that ordinary recessions, without the credit buildup behind them, simply don't produce. This is now something central banks actively monitor, using a measure called the credit-to-GDP gap, how far private credit has grown above its long-run trend relative to the size of the economy, tracked by institutions including the Bank for International Settlements, specifically because of findings like these. It is not a fringe theory or a single economist's pet idea. It's one of the most rigorously tested empirical findings in modern macroeconomics, built on a dataset spanning nearly a century and a half and confirmed independently across 3 separate published studies, each one available for anyone to check against the underlying data themselves. Central banks in multiple countries now publish their own credit-to-GDP gap estimates on a regular basis, precisely because regulators concluded in the years after 2008 that watching this single number closely might have given them a meaningfully earlier warning than the indicators they had been relying on before. Not opinion. 138 years, 14 countries, 223 recessions, and the single variable that predicts whether a downturn turns into a disaster isn't unemployment, isn't inflation, isn't the stock market. It's how much private credit grew in the years right before it. Every case study in this video is a single illustration of a pattern that has now been tested at a scale no single case study, however carefully documented, could ever provide on its own. None of this means an ordinary person needs to be able to predict the exact day the next crisis hits. Nobody can do that reliably, including the economists who study this mechanism for a living. What the data does offer is something more useful than a forecast. A way to read the water level rather than guess at the weather. When private credit is growing far faster than the underlying economy, year after year, that's not a neutral sign of prosperity. It's the exact condition that 138 years of data says has preceded nearly every deep, systemic recession on record. It doesn't tell you the date. It tells you which years are the dangerous ones to be carrying maximum leverage into. That distinction matters for how this thesis actually gets used, rather than just admired as an interesting historical pattern. A household, a business, or a policymaker who understands the credit cycle mechanism isn't handed a crystal ball. What they're handed is a reason to treat a long, calm expansion with rapidly rising private debt as a period demanding more caution, not less, precisely because that calm is the psychological condition Minsky identified as the seedbed for the next round of fragility. The years that feel safest to take on maximum leverage are, according to more than a century of data, disproportionately the years in which that leverage turns out to matter most. That's a genuinely useful, actionable reframing of an ordinary economic expansion. Not a warning to panic, but a reason to ask a different question than the one most people are asking during the good years. None of the 3 historical case studies in this video had access to 138 years of aggregated data warning them what was coming. The people extending margin loans in 1929, the bankers lending against Tokyo real estate in 1989, and the mortgage originators approving loans in 2005 were all working with the information available at the time inside a system that rewarded exactly the behavior that eventually broke it. The advantage anyone watching this video has that none of those historical participants had is the finished dataset. The ability to look at the credit numbers in real time and know from 138 years of precedent, roughly, what they tend to mean. That's not a small advantage. It's the entire difference between repeating history and recognizing it while it's still happening, which makes the current moment worth sitting with for a second. Global debt, government, corporate, and household borrowing combined, across roughly 70 of the world's major economies, hit a record high of approximately $353 trillion in the first quarter of 2026, according to the Institute of International Finance, after climbing by nearly $29 trillion in 2025 alone, the fastest single-year increase since the pandemic-driven surge of 2020. The global debt-to-GDP ratio has held roughly steady at around 305%, even as the dollar figure keeps climbing, which the IIF's own analysts have flagged as a genuine risk factor, precisely because so much of the recent growth has been concentrated in a small number of large economies rather than spread evenly. None of that, on its own, guarantees a crisis is imminent. Plenty of expansions with rising credit have unwound gradually rather than catastrophically, and debt growing alongside a growing economy isn't automatically a warning sign. But it is the same underlying mechanism, measured in the same units, that inflated the balloon in 1929, in Japan in the late 1980s, and in American households before 2008. The instrument that predicted those 3 collapses better than any other economic indicator available is currently reading at one of its highest levels in recorded history. Go back to where this video started. 3 recessions, 3 different-looking triggers, and the instinct to treat each one as its own unrelated story. A stock market crash, a real estate bubble on the other side of the world, a mortgage crisis, 3 pins, 3 different shapes, underneath every one of them, the same balloon inflated the same way, by the same accumulation of private credit, outrunning the economy it was supposed to serve. The mechanism that took down 1929, Japan, and 2008 isn't a historical curiosity. It's still running quietly in the background, every single expansion inflating again right now. The only real question left, the one this video can't answer for you, but can at least make sure you're asking with the right framework, is how big the next pin turns out to be, and how much debt will have built up underneath the balloon by the time it finds one. 3 case studies, 138 years of data, and one number reading near a record high today. That's not a prediction. It's an autopsy of a mechanism that has never actually stopped operating, running in real time on an economy you're a part of. If you want the documented, data-driven breakdown of the next hidden pattern behind the headlines, subscribe to Market Autopsy. We publish a new investigation like this every week.